Today, the Bureau of Economic Analysis released the advance estimates for the fourth quarter of 2008. The numbers weren't pretty. Real GDP fell 3.8% in annual terms, which means it fell about 1% during the quarter. These numbers are not pretty. They're especially not pretty when we reflect that 7.2% of the labor force is unemployed. Today, I hope to help answer the question of why this recession was unavoidable and argue that it will be, in the end, good for the economy. The story starts in the span of the years 2000 to 2002. During this time, the dot-com bubble burst. Stocks, as measured by the Dow Jones Industrial Average, fell about 40% between the beginning of 2000 and late September 2002. The Nasdaq, which contains more of the high-tech companies that participated in the bubble, fell 80% during that time, and still has not even come close to the highs it had in early 2000. In an attempt to keep this havoc in the financial markets from spreading into the broader economy, the Fed cut interest rates. The federal funds rate was slashed from 6.5% in mid-2000 to 1% by July of 2003. As a result, banks could get money quite cheaply, and they made this money available to the market, mostly in the form of mortgages. Interest rates on mortgages, especially adjustable-rate mortgages, were quite low from 2003 through 2004, and this encouraged people to buy their first homes, second homes, and investment homes. As a result, home prices increased substantially. As interest rates fell throughout 2000, home prices increased 12%. Now, they slowed down a little bit in 2001, largely because we were kind of still in a deeper recession at that point than in 2000, but they still rose 7%. Now, by 2002, we had overcome this recession, and cheap loans were readily available. As a result, home prices went up by another 12% and continued that trend all the way into early 2006. The increase in home prices and the large demand for new homes increased home construction, and between 2000 and 2005, housing starts increased about 30%, and about 600,000 construction jobs were created. The higher home values allowed people to take out home equity loans, and the quantity of home equity loans quintupled from 2000 to 2006, and continued rising even after the housing market began to fall in 2007. People consumed all of their incomes and then some, fueled on by this cheap credit provided by home equity loans. Now, alas, all this did begin to take its toll on prices. Inflation reared its ugly head, and not only in home prices, as we had been seeing from 2000 through 2006, also in the stock market, which started to recover around 2003-2004, but also consumer prices started to increase. In 2007, the consumer price index increased about 5%, significantly above its normal level of around 3 or 3.5%. Now, with inflation threatening, the Federal Reserve took action. From 2004 to 2007, the federal funds rate was increased from 1% up to 5.25%. This led things to unravel. At higher interest rates, homes were no longer attractive, and potential home buyers decided just to rent instead. And there was no speculative buyer to be found at all. To make matters worse, many of the homes purchased during the early part of the boom were purchased with adjustable-rate mortgages, and all of those families would see their rates and therefore their mortgage payments increase substantially. Often they'd be unable to pay and would get foreclosed. A flood of bank foreclosures further depressed housing prices, home construction slowed considerably, and the construction industry shed over 1 million jobs from the height of the construction boom in mid-2006 to this past December. In other industries, even more jobs were shed as homeowners cut back their spending, as credit was not available as during the boom. With housing prices falling, homeowners could no longer count on using home equity loans to purchase goods, so they were forced to cut back their purchases. Mass layoffs also added to the need to cut back. So why then is this recession upon us? Because artificially cheap credit fueled a housing and consumption boom, which encouraged workers and investors to move into construction, financial companies, and consumer goods industries. The cheap credit, however, could not last. It was only made available by the Federal Reserve keeping interest rates low by creating new money. For them to keep interest rates low, they'd have to continue creating more new money, which would lead to more inflation. Last time I discussed the fact that deflation is really nothing we should fear. Deflation increases the value of savings, encourages savings, and makes the goods we buy more affordable. Inflation, however, is a totally different story. Inflation diminishes the value of savings, decreases savings, and makes the goods we buy less affordable. In extreme cases, or what we call hyperinflations, inflation can destroy the value of the currency completely. It happened in interwar Germany, and it happened in Argentina just a few years ago. Letting inflation happen is not a good option, so the Fed had to fight it by increasing interest rates. Once it did, the industries fueled by cheap credit had to contract. Now, we have to move all of these workers and investors into other fields. The problem, of course, is that for that to happen, some workers have to lose their current jobs. Some investors will have to take losses, as the companies they currently own just aren't going to be profitable. But this readjustment, this recession, is absolutely necessary. It may be painful temporarily, but the alternative, not allowing this readjustment to occur, is no good at all. We don't need to have people building more houses. We already have more than people are willing to buy. We don't need more mortgage loans. We're having trouble paying the ones we have. We don't need more consumer goods. The cars and TVs we have work, thank you very much. What we need to do is reallocate the workers and the capital we've put towards these uses into other uses. Now, exactly what those other uses are, I can't say for sure right now. If I could, I'd be far wealthier. But I do know that we don't need more of the same. We need to adjust, and the adjustment process may be painful. However, it is necessary if we're going to put our economy on a more sound footing.